Hello, everybody. This is the accounting professor, and welcome to yet another video here. We're going to be going through a comprehensive problem here for owner's equity. Hopefully, I get the answer correct. If I don't, my students will be sure to correct me. That's what I love them for. My disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College in the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky, all rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of the other parties. I do not claim any copyright to those other parties. So let's go ahead and before we say thank you and good night, let's go ahead and take a look over here at our practice question for today. So we've got ZYY. Beginning shareholders' equity on January 1st, 2022 was as follows. Common stock, par value, million shares authorized, 2 million shares issued, and 180,000 shares outstanding. Additional paid in capital common stock, treasury stock at cost, 20,000 shares, retained earnings, giving us total shareholders' equity. So when I just kind of go through and add these up, we got, got 12.4 million. Okay, I added that up twice. So let's go ahead and make this a little bit nicer. Okay. So the first thing is over here, the Treasury shares were acquired on April 1st. No Treasury shares have been reissued as of January 1st, 2022. On February 1st, ZI declared and made a 4-for-1 forward stock split. All shares were affected, including the Treasury shares. On 4/1/22, they sold 5,000 Treasury shares, sold 10,000, sold 13,000. And then over here, I sold 400,000 shares to investors for 15 per share. I declared a 50 cent per share dividend to shareholders of record, paid the dividend on 10/1/22, and then I had net income for the year. So we have to go through and make journal entries for B, C, D, E, F, and G. And then we're going to have to answer these other questions below. So let's go ahead and take a look at, kind of where we are. So if we look at our owner's equities, we've got shares authorized. Probably have one too many zeros. We'll call this 1/1/22. We've got issued, and we have outstanding. Okay, we're going to par value is $2. And the way we got that par is by taking 0.0001. And if I multiply this by 0.0001, I get $2. Additional paid in capital. And then we're going to have treasury stock. Shares are at 20,000. And we'll go ahead and put this, we'll put this over here, 20,000. And then also over here, basic treasury stock at cost is 800,000. Okay, and then over here, retained earnings was at 5.2 million. Okay, and I have one too many zeros. Okay. It's a little bit bigger. Perfect. These are going to be in dollar amounts. Of course, the treasury stock shares, this is going to be in shares right over here. And the first thing, just to kind of look at this right over here, and I talked about this in the other equity video, is that the difference between shares issued and outstanding is what shares we've kind of gone through and have repurchased. So we went out and basically bought 20,000 shares at basically 800,000. Or we went out and we basically spent roughly about $40 per share. Okay. So with all that being said, first thing I'm going to kind of go through and do is I'm going to basically, we have a 4-for-1 forward stock split. What does this mean? I'm taking away one share and then I'm going to basically issue four. How does this happen? The board of directors has to go through and agree to it. They announce it, and then they go through and then they make the split. So how is this going to impact things? So basically over here on split on 2/1/22, what exactly is going to happen? Well, if it's a forward split of 4-to-1, what this is going to effectively do is it's going to impact our shares authorized, issued, and outstanding. And it's also going to impact the Treasury shares as well. So this here is going to be 1,000,000 times 4. This is going to be 200,000 times 4, 180,000 times 4, and then 20,000 times 4. And when we go ahead and look at this also as well, in terms of the par value, basically per share, this is also going to be adjusted. And the reason why is if I take 800,000 times 0.0001, this is going to basically be at 8. So my old par value is 0.0001. My new par value, I'm going to basically take the old and divide this by 4, and I'm going to show you how this kind of works. So my new par value right over here is going to be basically that fraction. Now, when I look at this here, right, under my new par value, the reason why I know that this is going to be correct is because if I take 800,000 times this new par value, I'm going to still get the $2 per share. Remember, additional paid-in capital, the dollar amounts are not changing. It's just basically going to be some of these, the par value will change, and then the share amounts will also be going through and changing as well. So again, this is really when these things happen. This is really going to be, the company announces it. It has to be a board resolution. And then obviously the transfer agent's going to be doing a lot of work as well. So let's kind of also kind of make our lives maybe like a little, well, we'll kind of get to that in just a second. So I've dealt with letter A, which is the 4-for-1 stock split. Now let's take a look at letter B. On 4/1/22, I sold 5,000 Treasury shares for $12 each. Well, if I'm reselling my own shares, right, what's not going to change are my shares authorized or my shares issued or my par value or my additional paid in capital, right? When we're dealing with Treasury stock, it's really essentially going to be over here as like, well, what's happening with our Treasury stock cost because we repurchase these shares and the value of these shares now is roughly at about $10 per share. How did I figure that out? Well, the cost of the Treasury stock was 800,000. That's how much money I spent on it. And post split, right, my new Treasury shares were 80,000. So this is basically going to be about $10 per share. So when it comes to the Treasury shares, so when I'm going through and kind of, if I'm going through and selling 5,000 of the Treasury shares that I've previously purchased for $12 each, let's go through and take a look at how that works. And I'll just go ahead and bring this over here. We'll kind of use the side area as our workspace. Okay, don't want to do that. Okay, so here we go. Now, when I look at my treasury stock account, right, we'll kind of do this up here. My treasury stock has a debit balance. Remember, when we look at treasury stock, right, and this is something just really kind of important to go through and remember, is that when we have our assets equals liabilities plus owner's equity, expenses, revenues, debits, and credits, the equity account typically has a credit balance, but here it is going to have a debit balance. And why is that? Because when we look at treasury stock, like right over here, when I go to the Home Depot and I'm looking at treasury stock, what you're going to see is it's like, well, all the balances over here have, basically positive amounts, meaning that they will have credit balances. But when we look at treasury stock, we see this whopping $95 billion, right? It shows up as a negative amount. So treasury stock is going to have a debit balance. If we kind of think about it, when we buy back our own shares, I'm crediting cash and I'm debiting because my cash is going out because I got to buy it. And then I'm debiting treasury stock. So the way we're going to go through and record this in terms of basically being a journal entry for this particular transaction is I'm receiving cash, and this is going to be 5,000 times 12 or 60,000. I'm going to basically get $60,000 cash. Now, for my every debit, I need a corresponding amount of credits. When I come over here to, and this is going to be on 4/1/22, we'll just kind of keep this cash going as well. So when I'm going through over here and I'm selling 5,000 treasury shares for $12 each, basically on 4/1/22, this is 5,000 times 12. And we'll call this letter B. So I'm getting cash of $60,000. Okay, so getting cash of 60,000. For every debit, I need a corresponding amount of credits. Now the question becomes is like, well, when I'm dealing with treasury stock, I'm going to credit treasury stock for the amount that I originally paid for it. So over here, the amount I originally paid for this treasury stock, because I bought it all at once per the question, this is going to be 800,000 bucks, and this represented 80,000 shares. Well, it was 20,000 at 800,000, but post split, right? This is now basically going to be at $10 per share. Okay, so my original cost on this was $10 per share. So here, what I'm going to do is I'm going to basically say over here for letter B, this is going to be 5,000 times $10,000 cost or 50,000. So let's take a look at our journal entries so far. Over here on 4/1/22, I'm debiting cash for 60,000. I am crediting treasury stock with a cost of that stock for 50,000 bucks. Now, my problem is here is my total debits do not equal my total credits. And here I need to have a credit of $10,000. Now, my instinctually, it's like, well, I bought it for 10 and I sold it for 12, and I would instinctively would want to basically credit as a gain, but we don't do that with when we're buying or selling our own shares. So what I'm going to use is I'm going to basically have an account called additional paid-in capital treasury stock. So record sale of treasury stock. Now, we're in academia right now. When it basically comes to treasury stock, what we also want to be very careful about is that as companies, we have to be very careful about when we are buying and selling our own shares of stock. And part of that reason is basically because it's not that it's kind of like insider trading, but I've got to be very careful about how I go out and announce what I'm going through and doing. So here, I'm going to basically create a new account called Additional Paid-in Capital Treasury Stock, and this is essentially going to be for 10,000. Okay, so that's how I go through and record transaction B. Okay, let's go ahead and take a look at the next one. So on 5/1/22, okay, and this is, okay. So the other thing I want to do right over here, basically for this transaction here for B, is I kind of want to go through and adjust my numbers as I'm going through and doing this, right? So my new shares outstanding, if we kind of think about what happened, right? Do I still own 80,000 shares? Basically, no. The answer to that is now I'm really only own, basically, it's now down to 75,000 shares because I just sold 75,000 because I just sold 5,000. So what does this mean? It basically means that there's going to be 5,000 more shares outstanding. And remember, basically the shares issued have to equal essentially the shares, basically the shares outstanding plus those treasury shares. So when you're going through and adjusting, like if I was to sell treasury stock, this amount would go down, and then over here, this would be increasing. So when I sell my own shares, remember these two numbers here have to equal my shares issued. My treasury stock at cost is also now going to be changing as well. So basically on 4/1/22, post this transaction, this is now going to be at 750,000. And I'm also going to have basically another column here, which is going to be additional paid-in capital treasury stock. And this amount over here is going to be at 10,000. Basically will be positive amount, meaning it's basically going to be a credit. Okay. So retained earnings has not gone through and changed. Okay. We'll go ahead and make another T account over here for the retained earnings. Okay. So again, when it comes to these accounts, right? So you're not going to necessarily balance out over here because we're not showing the cash, but at least you're able to kind of go through and see that, okay, this is kind of how this is kind of going through and working. Okay. So let's go ahead now and let's go to the next one. Remember, par value is not being impacted at all. That's just basically going to be staying the same. Additional paid-in capital, and I'll say this is APIC. Common stock, this is not changing, right? Because I'm dealing, that additional paid-in capital was recorded when the shares were initially issued. This is essentially what's happening when my shares are being reissued. Okay. So let's go over here now and kind of take a look at this next one. On 5/1/22, I sold 10,000 treasury shares for $8 each. Let's go ahead and do the easy part first. I'm receiving cash, and this is going to be 10,000 times $8 each. And then I also have to go through and I also need to record the treasury stock at my original cost. So over here, how much did I originally pay for these 10,000 shares? Well, I basically paid $10 per share. So what I need to do over here is I need to say, well, 10,000 times 10, or this is going to give me $100,000, right? So cash, and this is going to be 5,122. This is 10K times 8. My cost on the treasury stock, this is going to be here at $100,000. Okay, now this is a situation where we're basically reselling the shares at $8. Okay, and we lost money. Well, we never call it losing money when we're dealing with our own shares of stock. Okay, so what do I need to go through and do for this particular, what do I need to do for this particular question? When I'm selling treasury stock at where you have, I need basically a debit to balance. The first thing I'm going to do is I'm going to take the additional paid-in capital treasury stock down to 0. So when I come over here, the most I can never go debit balance on the additional paid-in capital treasury stock. So I want to make this go down to 0. So here I'm going to have a debit to additional paid-in capital treasury stock. So this right here, it's going to be a debit to additional paid-in capital treasury stock. Now the problem I have now is that my total debits do not equal my total credits. Instinctively, I would want to record a loss, but I cannot do that. So what's going to happen is I'm going to basically debit retained earnings or 10,000 or whatever I need to do to balance after I've exhausted the additional paid-in capital treasury stock. And this is to record sale of treasury shares. Okay, so that's what I'm going through and doing. Okay, so now coming over here, let's go ahead and update our T accounts. So we updated this here. This is also, we'll just call this from transaction C. And then here I am debiting retained earnings for 10,000, and this is also from transaction C. Okay. So my new balance in retained earnings is going to be 5,190,000. My new balance in additional paid-in capital treasury stock is going to be at 0. And my new balance over here for treasury stock is going to now be at 650,000. So let's go ahead and update our chart. Okay, so over here, we've got C, we've got 5,122. Shares authorized do not change. Shares issued do not change, right? What is going to change, though, is my shares outstanding. And because I just sold another 10,000 shares, this amount here is going to go up. So my new shares outstanding is now going to be 735,000, right? I'm releasing these back out into the wild. This is not going to change. Additional paid-in capital is not going to change. Also here, though, my treasury shares, right? There's no longer 75,000 that I'm holding. I released 10,000 of them, or I sold 10,000. So now my treasury shares are now at 65,000. My treasury stock at the cost of this is now going to be going down by 100,000. So my ending balance here right? This has a debit balance. I'm crediting treasury stock, so this is going to be at 650. This has a credit balance. I'm going to basically move this down to 0. And my retained earnings is also going to be going down by that 10,000. It's not a loss, but rather we never record We're basically debiting retained earnings. Retained earnings typically has a credit balance. It's part of owner's equity. So my new ending balance here for retained earnings is going to be 5,190,000. I get a lot of students who will ask me, Bennett, should I be going through and, why do you use T accounts? Because honestly, when you are practicing these questions, T accounts will always help you get to the right solution, especially if you're on that pathway of wanting to go through and to take that CPA exam. Okay, let's take a look at the next one over here. Over here on 6/1/22, I sold 13,000 Treasury shares for $9.50 each. Okay, so same thing. Okay, so on 6/1/22, I'm debiting cash. How much do I debit cash for? It's going to be $9.50 times 13,000. Okay, over here, I also need to go through and to credit Treasury stock. What did I originally pay for the shares? We originally paid $10 per share. So this here is going to be 13,000 times 10. And then here's my situation. Okay. Now, ordinarily, the first thing I go to do is I would go to additional paid in capital Treasury stock, and I would make this until I can never have a debit balance, but I want to make it go down to zero. It's already at zero. So what do? I'm going to go ahead and debit retained earnings for the difference between these two amounts. And this is going to be, again, to record sale of Treasury shares. So this is letter D. Let's go ahead and put these in. So here I'm crediting Treasury stock for 130,000. Okay, this is now going to have an ending balance in terms of my Treasury stock of 520,000. For letter D on 6/1/22, this is going to be 950 times 13,000 shares. So this is going to be over here at 123,500. And then lastly, we've got retained earnings, which we are going to be going through and debiting for 6,500. Okay, remember, this is not a very realistic real life example because more than likely you would not be able to sell shares like this because there's blackout periods, there's all kinds of stuff. But the reason why I'm kind of showing this, basically sharing this with you, is just to kind of get an understanding in terms of how when we're reissuing or reselling our treasury shares, how do these numbers kind of work out? So let's go ahead and now update our chart. So we'll go over here to letter D. This is going to be 6/1/22. Shares authorized, not changing. Shares issued are not changing. Now, though, I'm increasing my shares outstanding by 13,000 because, again, I'm re-releasing these out. Now my shares outstanding are going to be 748,000. Par value not changing. Additional paid in capital common stock is not changing. My treasury shares, right? This is going to be decreasing by 13,000 because I'm no longer holding these in the treasury. One of the things you can do is that remember my treasury shares plus my shares outstanding need to equal my shares issued. So if you're kind of messing up, it's kind of like, not making sense. That's something you can kind of go through and look at. So then over here, my treasury stock at cost, I'm basically adjusting this by 130,000. So now I'm at 520. There was no impact to additional paid in capital treasury stock. But then over here with my retained earnings, I'm decreasing that balance by 6,500. And now my ending retained earnings is going to be 5,183,500. Okay. All right. So let's go ahead now and take a look at this next one over here. So letter E. Okay. So right over here, letter E. Okay. So on 9/1/22, I sold 400,000 shares to investors for $15 per share. This was a new share issuance and did not impact any of the Treasury shares. So let's do the easy part first. When I go through and do this on 9/1/22, first I'm going to say is, okay, how much cash am I receiving? This is going to be 400,000 times 15 or $6 million. Okay. Now, at the same time, my credits are going to be to two places. I have common stock at par and additional paid-in capital common stock. So that's what I'm kind of going through and here dealing with, and this is going to be record share issuance. Okay, now what is my par value? Well, as we kind of saw from the very beginning, it's my par value changed, right? Why did it change? Well, it was at 0.0001, but after the share split, it's now going to be it's basically going to be 1/4 of that because I did a forward split. Remember, when I go through and did this, right, if I have like basically my shares issued 200,000 times 0.0001 gives me $2 per share, right? If I use that same 0.0001 at 800,000, that would have given me $8. So that's why I have to go through and change this up. So what I'm going to do is I'm going to go ahead and borrow this. So okay. So now to basically figure out the amount I'm going to input in at par value is I'm going to take over here, this is going to be 400,000 shares times the fractional par value, or it's going to give me over here at $1 common stock par at $1. So this is going to be 400,000 times 0.000025. So that's how I'm going through and getting to that, basically getting to this particular answer. I shouldn't have done that. Let's go ahead and put this over here. Okay. Now, the difference here between this is going to be 6 million minus a buck, right? This is always basically going to be a plug. Okay. Now, let's go ahead and adjust up our T accounts over here for our cash. And you don't have to do this for cash, but we're just kind of doing this to basically just kind of balance things out. Basically debiting cash. I'm also going to be going through and debiting two new accounts, which is going to be my common stock at par. Which prior to the share issuance, basically over here had a balance of $2. And then I've got my additional paid-in capital common stock, which prior to the share issuance here was 7,999,998. So here I'm going to be increasing this amount by $1. And then over here, I'm basically going to be going through over here and showing this increase to my additional paid-in capital common stock. Okay. So now my common stock at par is going to be at $3 per, it basically be at $3. And my additional paid-in capital common stock is going to be at 13 million. But let's go ahead and now take a look at what's happening over here. So when it comes over here to the letter E, and this was on 9/1/22. Okay, so the shares authorized, this is not changing, right? That is not changing at all. but my shares issued, because I'm issuing another 400,000 shares, right? This is a new issuance. So I'm issuing 400,000 shares. So this is going to increase my amount of my shares issued. It's also going to increase the number of my shares outstanding, right? Because my shares issued and outstanding, these are now out in the general public. This is not, I still own 52,000 shares, right? This is not, none of the Treasury stock amounts are being impacted by this, right? None of this here is being impacted. Retained earnings is not being impacted, but my new par value is basically going to be that dollar. And then over here, my additional paid-in capital common stock is increasing by $599, $999. So my new amount of additional paid-in capital common stock is going to be $13,999,997. Okay, so let's go ahead and take a look at F and G. And so we have over here, we declared a 50-cent per share dividend to shareholders of record. And then I went through and I paid the declared dividend. Okay, so let's go ahead and figure this one out. Okay. And let's kind of freeze this up. Okay. And I'll just do this for the moment. So over here, so letter F. Okay. So I declared a 50-cent per share dividend to shareholders of record on 10/15/22. When I go through and I'm basically doing my declared dividend, right? Is that, well, how do I go through and do this? When I declare a dividend on 10/1/22, the journal entry I'm going to be making is going to be a debit to dividends. And then I'm going to be crediting dividends payable. Okay. To record dividend declared. Now, what's going to ultimately happen with the dividends, right? And where we put dividends is on our statement of retained earnings. We have beginning retained earnings. Our retained earnings are increased by our net income, and they are decreased by our dividends. And this is going to give us our ending retained earnings. Okay, so beginning retained earnings plus net income minus dividends is our ending retained earnings. Our dividends, right, is a temporary account. It tells us during a period of time how much did we actually declare in dividends. Net income is revenues less expenses. These are all temporary accounts that ultimately get closed out to retained earnings, which is our linkage between our income statement and our balance sheet. So now the key thing I need to do here is to say, how do I determine the amount of the dividends I'm going to pay out? Well, I need to take the shares outstanding and multiply it by the dividend amount per share. And why don't I not use shares issued? And the thing is, if I did do that, I would be paying myself a dividend because I own 52,000 of these shares. That wouldn't make any sense. So here I'm going to take 1,148,000 and multiply that by 50 cents. So the amount of my dividends that I'm going through and essentially paying is going to be right over here at 574,000. Okay. So let's go ahead and do the actual payment of the dividends, and then we'll kind of go to like the net effect. So on 10/30/22, I paid the dividend declared on 10/1/22. So on 10/1, so this is 10/30/22. I'm going to basically be debiting dividends payable. I'm going to credit cash. So over here, this is going to be 574 to to basically to pay dividend previously declared. Okay. So that's how I go through and do the journal entry for this one here. Now, when it comes to our chart, right? And okay, so when I come over here to F, and this is going to be on 10/1/22, when it comes to shares authorized, issued, outstanding, par value, additional paid-in capital, common stock, Treasury stock shares, Treasury stock cost, additional paid-in capital, Treasury stock. It's not going to really impact any of those. But ultimately, this will be impacting retained earnings because we're going to close this out to retained earnings. When we close out dividends to retain earnings, the way the closing process will work is that if we have over here, essentially we have dividends. We've got over here dividends of 574. How do I close out accounts? Well, I need to know, what do I need to do to make this temporary account go to zero? So right over here. So basically I would credit dividends and then I would debit retained earnings. So I would be debiting retained earnings for that amount. And so we took this over here. I think we are on transaction F. Obviously this could happen at the end of the period. It's entirely up to you how we go through and do this. But again, I'm just kind of doing this over here for our own notation, right? So our retained earning balance post dividend is going to be 5,183,500 minus the 574 or 4609,500. So when it comes to this over here, my retained earnings is going to go down by here because we're giving out that amount to our shareholders. And so our new balance here in retained earnings is going to be 4,609,500. Notice that when I actually pay the dividend, this is a liability that's created once I declare it. And then this is the ultimate entry you make as a debit to dividends crediting cash. But when we declare it, we create the liability. Okay. So that gets us to right over here. This gets us over to the last one, which is going to be letter H. Okay. So for letter H, and this is on 12/31/22, and this is basically we have net income. Okay. Shares authorized, shares issued, shares outstanding, par value, additional paid-in capital, common stock, Treasury shares, Treasury stock costs, additional paid-in capital. None of that is going to change. However, when we have net income, right, and what exactly is kind of like the net income thing? It's like, well, my revenues basically exceeded my expenses, right? So over here, my net income was 5.3 million, right? So over here, I would ultimately have right? And what I need to do is basically here, I need to make my revenues and expenses go down to zero. How do I make this go down to zero? Well, I'm going to need to basically debit this account over here. And so for every debit, I need a credit, and I would be going over here and then crediting retained earnings. Okay, so that's kind of how we are getting to where we are right now. So when I have net income, this is basically, I'm going to put this in over here. So my new ending retained earnings is going to be 9,909,500. Okay. So that's going A through H. Now let's go ahead and make sure we've done everything. We've prepared separate journal entries in proper form. What do I mean by proper form? Date, description, and the accounts you are debiting and crediting. So that's what we're doing. Make sure that when you are going through in my classes, if you are crediting an account, it's got to be indented because over here, the credit is being indented from the debit. By the way, I always recommend people to handwrite out solutions. And I'm a huge believer in this. If you go to my YouTube channel and you do a quick search on my YouTube videos, you just search Ninja, and I don't know what happened there, but let's search my channel. So I did an interview with Jeff Elliott, and he is the founder of Ninja CPA Review, also something called Another 73 or Another 71 on Reddit. But he talks about the importance of handwriting out solutions. There is something about that which is really kind of lost when you are studying accounting. The best thing you can possibly do is you want to handwrite solutions over and over again because it's going to be that part that's really going to help you get it into your brain. So great video to watch. I will leave a link in the description below on how you can watch or basically to watch this video. Let's go back over here though. So we've done the journal entries in proper form. And now determine the number of shares authorized, issued, and outstanding. Well, my shares authorized, let's go ahead and we'll unfreeze this. Okay. So my shares authorized as of 12/31/22 is going to be 4 million. My shares issued as of 12/31/22 is going to be 1.2 million. And then over here, my shares outstanding are going to be 1,148,000. My ending par value for my common stock as of 12/31/22 is going to be at $3 per share. My ending additional paid in capital is going to be 13,999,997. My ending treasury stock as of 12/31/22 is going to be over here at 520,000. Okay. Additional paid in capital treasury stock, this is going to be 0 because we blew through it earlier. So the additional paid in capital, because we had the losses on the sale. So the additional paid in capital treasury stock is going to be at 0. Okay, so coming over here, determine the ending retained earnings as of 12/31/22. That is going to be 9,909,500. And of course, I might be wrong but my great students in accounting 202B will, in summer of 2026, will set me off on the right direction. And with that being said, I have another video I get to make because I made a mistake. So, the most important thing, by the way, is when you do make mistakes, please make sure you admit to them. You admit to them and you move forward. Like I'm very happy that one of my students proved me wrong by getting an investment banking position when he transferred to USC. And I told him that investment banking is extremely challenging to get into, but he absolutely proved me wrong, and I'm very happy and proud of him for that. So, in any event, thank you for joining me here today. And let's go ahead and show there we go. Thank you for watching. Make sure you like and subscribe. And if you over here, if there's anything, if you have any questions, feel free to message me or email me at ivc30tocpa@gmail.com. And I look forward to seeing you on future videos. Have a great day.